Welcome back to the Deep Dive. Today, we are strapping in for a high-speed journey right into the heart of modern finance.
We really are.
Our mission, as always, is pretty simple. We want to cut through the complexity of terms like RTGS, NEFT, and MPS.
All those acronyms.
Exactly. And turn them into practical, usable knowledge so you know exactly what's happening when you press that send button.
And this is, a really necessary deep dive because the financial landscape is going through this massive, irreversible shift.
It feels like it's accelerating every year.
It is. We're tracking this evolution away from the sort of slow physical branch model to one that's just utterly dominated by instantaneous digital transactions.
Right.
Our sources show this relentless focus on three main pillars: speed, security, and of course, 247 access.
Okay.
So we'll be dissecting the three big funds transfer systems, analyzing how core technologies like CBS have enabled this, and exploring some of the paradoxes in mobile and online banking.
Okay, let's unpack this by starting right where the action is. The actual systems, the engines, that dictate how fast your money travels.
Good place to start.
Because if modern banking is like a complex transit network, we really need to know the schedule, the capacity, and the design of the vehicles.
That's a great analogy.
So we're diving into real-time gross settlement, national electronic funds transfer, and the immediate payment service. The whole world of digital payment really seems to boil down to the differences between real-time, batch processing, and that crucial factor of nonstop 24/7 availability.
Exactly. So let's begin with RTGS. When you see that acronym real-time gross settlement, you should immediately think two things: high value and high commitment.
Okay.
It's really the gold standard for large-scale movement of money.
I found it fascinating how the sources just define the whole system based on those three words. Let's take real time. In banking terms, this means that as soon as a payment is processed and validated, the settlement happens immediately.
Instantly. There is no waiting period, no queue.
It's instant finality.
It is. And then you have the gross aspect. This is the operational difference that separates RTGS from pretty much everything else.
How so?
Gross settlement means each transaction is handled individually, one-to-one. They aren't bundled or grouped together.
I see. So they're not netted against other transactions flowing through the system.
Not at all. Each one gets its own dedicated confirmation.
That is a critical insight. So if I'm moving, a huge sum for a corporate acquisition or a real estate purchase,
right,
that money isn't just lumped into a queue with thousands of smaller transfers.
No, it gets its own dedicated, high-priority, secure lane on the digital highway. It's processed completely independently.
Which is why RTGS is the fastest possible system for moving significant amounts of money through the sort of formal banking structure.
Precisely. It's where that instant finality and absolute certainty of settlement are just paramount to the user. Yeah. This is not designed for your everyday consumer transfers. This is institutional-grade service.
And the regulatory requirements really underscore that purpose perfectly. Here's where it gets really interesting for the user. The minimum transaction amount.
Yes.
It's EBIRS 2000, that's the floor. That specific high minimum immediately tells you who the system is for.
That 200,000 rupee threshold, it acts as a regulatory boundary. It signals that this is reserved for, material financial movements.
And that reduces the overall transaction volume.
It does, which allows the system to maintain that high-speed individual processing standard. And on the flip side, the sources note there is no upper ceiling for an RTGS transaction.
Not at all.
None. So massive capital transfers can flow through this channel completely unimpeded.
The finality of the transaction is also a defining and, frankly, a bit of an intimidating feature.
It is.
The transfer is both final and irrevocable. Once you hit send and it's processed, there's no stopping it. No reversing course.
That's it. That high commitment goes hand in hand with the high minimum value. And that irrevocable nature connects right back to the gross settlement principle.
Because it's handled individually.
Exactly. Because each transaction is isolated and settled on its own, its finality is secured the moment it passes through the system.
But for a service built around speed, its availability is surprisingly rigid.
Yes, that's the trade-off. It reflects its status as a highly formal, regulated system.
This is where we see that tension between the old infrastructure and the new tech. Despite being the fastest settlement system, RTGS is not a 247 service.
Not at all. It operates on structured banking hours, 9:00 a.m. to 3 p.m. on weekdays.
And a shorter window on Saturdays.
Right, 9:00 a.m. to 12:00 noon. And our sources emphasize that access is only guaranteed through CBS-enabled bank branches.
So that time constraint, it stops it from competing with modern 247 systems on availability. But the quality service during that window is, what, unrivaled?
Unrivaled. The documents guarantee the speed. The beneficiary bank must credit the customer's account within 30 minutes of receiving the transfer message.
Wait, must. So that's not a service goal, it's a rule.
It's a regulatory obligation. That 30-minute requirement is a commitment baked right into the financial infrastructure.
That's a key insight. A half-hour window for major financial finalization. That explains why institutions and high-net-worth clients rely on this, even with the limited hours.
It does. It guarantees a rapid closure that's essential for time-sensitive, high-value operations. That individual, non-batch processing is what makes it the most trusted channel for significant capital movements.
Okay, so if RTGS is the dedicated high-security private jet, let's move on to NEFT, National Electronic Funds Transfer.
Right.
This feels more like the scheduled commuter train of the financial world.
Yeah.
The system most people use for routine, everyday transfers. And it operates on a totally different principle.
It does. The difference lies entirely in the principle of settlement. Unlike the instantaneous gross settlement of RTGS, FFT transactions are settled in batches.
Batches.
Okay. At specific, periodic intervals throughout the day. So if you initiate a transfer, it doesn't leave immediately. It waits in a pool until the next designated settlement time.
The next clearing slot.
Exactly.
So that batch processing means there's a slight but predictable delay. If I hit send 5 minutes after a slot has closed, my money has to wait.
It has to wait potentially for an hour or two until the next batch runs.
And the sources detail these windows pretty specifically.
They do. 7 transaction times a day on weekdays, running between 8 a.m. and 7 p.m., and then 6 transaction times on Saturdays from 8 a.m. to 1 p.m.
And this pooling, I assume, is what makes the system so efficient for just the massive volume of standard transfers that happen every day.
It's incredibly efficient and cost-effective, yes.
The testability seems really high, too. It just requires a bank branch to be NEFT-enabled, which is almost everywhere now.
It's very widespread, but there's one specific detail that really stood out as a huge mechanism for financial inclusion.
Oh, I think I know what you're talking about. Bridging that gap between the cash economy and the digital ledger.
You're referring to the unique feature that lets you transfer funds without having a bank account at all.
This is amazing. An individual can just walk into an NFT-enabled branch, deposit cash, fill out a form, and send the money electronically.
Yes.
I need to pause on that because that's a massive deal that supports people in remote areas or anyone just starting out in the formal economy. It provides crucial access without the barrier of creating an account first.
It absolutely does. It's a vital inclusion tool. However, this non-account use comes with a strict safety measure.
A limit.
A limit. The maximum amount you can transfer without a bank account is capped at RTGS 49,999.
Which makes perfect sense. It keeps the cash deposit method for necessary consumer transactions and prevents it from being exploited.
Exactly. Now, for those who do have an account, the limits just vanish. The system is extremely flexible for account holders. There's no minimum or maximum amount for account-to-account NFT transfers.
Okay, so it operates for all sizes of routine payments. But there's one restriction.
A necessary one. It's purely a domestic system. NEFT cannot be used to receive foreign remittances. It's built for internal fund flows only.
Let's talk brass tacks. The cost. The efficiency of the batch system must translate to pretty low consumer charges.
It does. The sources lay it out very precisely. First, the receiver pays absolutely nothing.
0. That's a great incentive for adoption.
It is. The sender, however, pays a tiered transaction-based fee. The lowest tier, for amounts of Rs 1,000 and below, is just Rs5 plus service tax.
That's highly competitive, perfect for utility payments or rent transfers.
And as the value goes up, the fee increases incrementally. For transactions between 1 and 2 lakh rupees, the charge is Rs15 plus service tax.
And for anything above the Rs 2,000 threshold, which is the minimum for RTGS, the NEFT fee is Rs25 plus service tax.
Right. This structured pricing encourages its use for medium to large transfers while keeping costs super low for everyday transactions.
So even though the fee for, say, a 5 lakh rupee NFT transfer is minimal, its speed depends on that batch cycle.
Which makes it less suitable than RTGS for a critical transfer that absolutely must settle now. It forces the user to make a choice, cost, or immediate certainty.
So we've covered the high-value, time-constrained Sprint RTGS and the scheduled cost-effective bus, which is an NFT. Now we get to IMPS, Immediate payment service.
The ultimate consumer disruptor.
Facilitated by MPCI, IMPS is the omnipresent, always-on scooter of the financial world. It just eliminated the waiting game entirely.
And the major draw of IMPS is deceptively simple, but it's fundamentally revolutionary availability. 24 hours a day, 7 days a week, 365 days a year.
It's the ultimate convenience factor. This continuous access, regardless of banking hours, weekends, holidays.
Yeah.
It's why it has just absorbed the majority of consumer transactions.
It is truly flexible and dependable. If you need to pay an urgent bill at 1 a.m. on New Year's Day, IMPS is there.
Right. Now, it's incredibly fast, but the sources note a crucial distinction compared to RTGS. They say IMPS usually takes less than an hour to transfer. That word, usually. It highlights that while it's near instant, it doesn't have that explicit 30-minute regulatory guarantee of a system like RTGS.
That minor difference in wording is key. RTGS is a specific high-security channel. IMPS is an immediate interbank transaction done through multiple platforms.
Primarily mobile banking.
Primarily mobile, but it also fully supports web and online banking using the standard account number and IFSC code. Its design maximizes reach and constant service, even if it doesn't carry that specific regulatory burden.
And its versatility is just unmatched. It's not only for peer-to-peer transfers anymore.
Not at all. IMPS is now the backbone for a huge range of consumer services. Online shopping, merchant payments, insurance premiums, utility bills, even school and college fees.
It's become the instant default for almost every consumer financial interaction.
It has. Now, to fully use the mobile platform for these transfers, the customer has to first generate a unique 7-digit MMAD.
The mobile money identifier.
Right. And this isn't just an arbitrary number. It's a specific security and routing layer. The MMBD maps your mobile number to your bank account,
which lets users send money just using a mobile number instead of needing the complex IFSC code.
Exactly. That mapping is crucial for the mobile experience. And the transaction security is built into the feedback loop. As soon as the transfer completes, which can be in seconds, both sender and receiver get an immediate SMS from the bank.
That instant notification is so vital for verification and fraud detection, especially when transactions are non-revocable.
Absolutely. Regarding costs, IMPS is designed to be inexpensive to encourage adoption, though charges do vary by bank policy.
It's a competitive system.
Very. Our sources give us some concrete examples. Up to Rs 10,000, it's about Rs 2.50 plus GST. This goes up from mid to high tiers, but the most interesting part relates to competition.
Yeah.
Some banks may not levy any charges on IMPS transactions above Rs 2,000.
Wow. That's a direct shot at NEFT and RTGS. It's the bank saying, we want your high-value transactions, and we'll use our 24/7 instant channel to get them, even if we have to waive the fee.
It illustrates the competitive tension perfectly. RTGS offers a high-commitment track during business hours. NEFT offers efficiency and predictable batches. And IMPS offers universal access and instant execution,
challenging the dominance of the older systems entirely.
But none of this digital fluidity, whether it's instant or batched, would even be possible without the technological foundation operating unseen behind the scenes.
Right. So we've established the transfer systems. Now let's talk about the infrastructure that actually supports them. The foundation is CBS, Core Banking Solution.
Also known as Centralized Banking Solution.
Right.
Yes, it's the architectural shift that really moved banking into the modern age.
And it's not a customer-facing product, right? It's the internal nervous system of the bank.
That's a great way to put it. To understand its importance, you have to look at the before and after. Before CBS, banking was decentralized. Your account was tied to the physical branch where you opened it.
You were literally a customer of the branch. I remember those days. If I needed a complex service or a large withdrawal in another city, I was basically a stranger to that branch.
Exactly. Delays, red tape. CBS completely flips that script. It creates a unified digital identity.
And that paradigm shift is really encapsulated in that phrase. Under CBS, you become the customer of the bank, not the customer of a branch.
The centralization of data moving the account ledger from a local branch server to a core, unified national data center, that is what enables the seamless experience we rely on today.
So when you open an account at one CBS-enabled branch, you get a unique ID that's valid across the bank's entire system.
Nationwide. That ID grants you access and privilege across the whole network.
And the benefits are transformative. It embodies that goal of speed banking anywhere and at any time.
It does. A customer can operate the same account across all CBS branches of the bank nationwide. This includes instantly transferring funds between accounts in different cities, a feat that was slow and costly before.
And it extends to physical convenience, too. You can walk into any CVS branch, withdraw cash, even get your passbook updated.
It eliminated that bureaucratic friction.
Yeah.
And CBS ensures that when money moves digitally via RTGS, NEFT, or IMPS, the accounts on both ends of the transaction recognize and integrate that change instantly.
Because they're all drawing from the same core centralized database?
Precisely. A debit in Mumbai is immediately reflected in the available balance in Delhi.
Okay, so moving from the core architecture, let's talk about e-banking. This is the user interface. Banking over the internet.
The front end that leverages the CBS backend, exactly. And its defining features inherently contrast with traditional banking. There's zero face-to-face contact.
And it requires technology on both ends, a computer or mobile device for the client and secure servers for the bank.
Critically, it also requires active participation. It's not automatic. The client has to formally opt in for the service.
And both the bank staff and the client have to understand the technology.
That mutual dependency is key to smooth operation. Now, the advantages focus heavily on convenience.
Of course. 24/7/365 availability, that's just table stakes now. The ability to transact from home, the office, while traveling. It completely removes the need for physical branch visits.
It saves a massive amount of time and effort.
And beyond convenience, there's an important element of security and financial discipline.
How so?
Well, increased security because you're not carrying physical cash. And the automatic recording of every transaction, it really inculcates a sense of financial discipline. It's much easier to track expenses.
That's a good point. And from the bank side, e-banking allows its network to expand far beyond the limits of physical branches. It reduces the load on those branches, too.
But every powerful tool has its limitations, and e-banking introduces some frighteningly high-risk factors.
The sources are very clear on this. The first barrier is the investment. Both the bank and its clients have to commit significant capital for the technology.
And then there's the ongoing expensive need for continuous training.
Exactly. Then there's the vulnerability of the digital realm itself. A technical defect, a system outage, a virus.
The customer is stranded.
Temporarily, yes. But the most alarming risk highlighted in our sources, and this connects directly back to the speed of IMPS and RTGS, is the potential for severe, non-revocable harm from simple human error.
This is where the lack of friction becomes dangerous.
Extremely.
I imagine that specific risk, that moment of dread after hitting send, is something everyone has felt. The source material gives a visceral example, mistakenly entering too many zeros.
Transferring Rs 5,000 instead of Rs 50,000.
And because systems like IMPS and RTGS are non-revocable and instantaneous, that mistake is final the moment it settles.
When you replace paper slips and human verification with a single screen tap, the margin for error shrinks to zero, but the financial consequence is huge. That's the defining tension of modern e-banking.
So if e-banking brought the bank to your desktop, mobile banking put the bank in your pocket.
Conducting transactions via your mobile phone, SMS, browsing, or apps, it's all designed for urgency and constant access.
Used for immediate things, fund transfers, bill payments, and quick inquiries like checking your balance.
Its convenience is unparalleled. And a key part of that convenience and security is the automatic SMS alert service.
A simple but incredibly vital tool. It acts as the immediate check and balance for the user.
The bank automatically sends an SMS for every single transaction, debit or credit. The text has the nature, amount, date, and current balance.
It gives you all the critical information instantly without needing to open an app, forming a real-time notification loop that's so critical for security.
And there are several powerful forces driving the explosive growth of mobile banking. The first is, predictably, cost.
It has to be cheaper for the bank.
At least 10 times cheaper than traditional branch banking.
Wow.
Then there's the enabling infrastructure. Free, user-friendly bank apps since 2010, interbank mobile payment systems since 2011, and major policy initiatives like Aadhaar-based cash transfers are expected to accelerate adoption even more.
But the most compelling driver is just simple reach. The research shows over 60% of the population, even those without a formal bank account, still have a mobile phone.
It provides a low-barrier path for financial inclusion by leveraging technology that's already out there.
But this explosive growth comes with significant hurdles. The first is a device constraint.
It works best on smartphones, but the sources say less than 20% of users have one. This makes the experience cumbersome for the majority using basic feature phones.
And this brings us to the core paradox we have to discuss, the account limit paradox.
Right. The policy mandates that one person can only have one mobile account.
The intent is regulatory, right? to check fraud by limiting the number of entry points.
Yes, but the unintended consequence for the user is that it centralizes all their risk.
By forcing all funds and access into one single mobile account, you're putting the user in a high-risk situation. If a fraudster compromises that single account,
They get everything.
it's a classic trade-off. The system reduces systemic fraud complexity, but it maximizes the individual user's exposure.
The potential loss in a single breach is total. It concentrates the risk instead of allowing it to be distributed, which is a key security challenge as mobile adoption just keeps increasing.
Okay, let's pivot away from the abstract transfer systems and software to look at the tangible instruments we use every day, starting with the two most common pieces of plastic in your wallet: debit cards and credit cards.
The fundamental distinction between these two is the source of the funds and, crucially, the timing of the payment.
Let's define the debit card first. This is money you already own. To use the card, you have to have money deposited in an account. Your spending is strictly limited by that deposit.
You can't spend what you don't have. So because the funds are pre-existing, there's no credit facility. The cardholder is not a debtor to the bank.
Payment by the cardholder is required before the card can be used. It's designed for immediate payment or cash withdrawal. The bank is just processing the transfer of your own money.
Now, contrast that sharply with the credit card. The source of funds isn't a deposit. It's based on reputation and creditworthiness. It's a pre-approved overdraft facility.
You explicitly do not need advance money in the account to make a purchase.
And that's the core difference. A credit card inherently provides a credit facility. Therefore, the cardholder is legally a debtor to the bank the moment a purchase is made.
And payment is required after using the card within a fixed billing cycle.
Since the bank is extending its own capital, the card requires security in some form, a credit check, an application to mitigate the bank's risk. A debit card just requires a deposit. The bank has zero risk.
Both card types might have fees, an annual fee or whatever, but the underlying risk calculation is completely different.
Completely. And of course, both are used by banks to offer incentives and discounts to encourage usage.
So the core difference is timing and commitment. Debit cards are about past payment. Credit cards are about future payment, a promise to pay later.
Well put. Next, let's discuss the ATM, the automated teller machine. It's one of the longest standing pieces of consumer financial tech.
Its core function is allowing customers to withdraw or deposit money 24/7 using a card and a PN.
And the sources highlight its sheer efficiency. It's significantly less costly and less time-consuming than a human teller. But its role has evolved dramatically beyond just dispensing cash.
Absolutely. We're seeing a functional transformation. ATMs are now becoming mini bank kiosks.
Reducing the reliance on physical branches for almost all routine tasks. It's part of a strategy to make the physical bank presence more distributed and accessible.
And to support this kiosk role, banks are installing all these other devices right next to the cash dispensers.
Yes, these supplementary devices. They include cash depositing machines that can handle loose cash, passbook printers, internet kiosks for self-service banking.
Information kiosks, phone banking devices.
Right. That whole ecosystem of machines means an ATM site can now replicate most of the core functions of a small bank branch without the overhead.
And the scale of this infrastructure confirms how critical it is. The sources say there are around 91,000 ATMs.
Which underscores their importance as these critical nodes that bridge the physical cash world with the digital ledger.
Okay, finally, we have to look at a traditional instrument that still serves a crucial role because of its built-in guarantee, the demand draft.
Or bank draft. Next to IMPS, it feels so antiquated, but it fulfills this non-negotiable need for guaranteed payment.
Let's define it clearly. It's a type of check drawn by a bank on itself or another bank in favor of a third party. Its primary purpose is safety.
The safety comes from the mechanism. The purchaser pays the bank the full amount of the draft plus a commission up front. The bank then issues the draft.
And because the bank guarantees the payment, it's payable immediately on demand, hence the name.
The key safety feature is there's absolutely no risk of dishonor, unlike a personal check, which could bounce.
Right. Since the bank already has the money, the payment is guaranteed. The commission is for providing that guarantee.
And while the instrument is traditional, its access has been thoroughly modernized. You don't have to queue up at the counter anymore.
Exactly. Thanks to e-banking and CBS, you can request a bank draft online. The amount and charges are debited directly from your account.
This marries the absolute safety of the bank draft, which is often required by institutions or governments that can't accept risk, with the convenience of modern e-banking.
The draft is still a guaranteed physical document, but the process of buying it is entirely digital.
Looking across all the sources, the trajectory is just unmistakable. Banking is moving toward an instantaneous, flexible, and completely remote model.
And this revolution is structurally supported by the core banking solution, CDS, which centralizes everything.
While the execution relies on those specialized channels, RTGS for high value, NEFT for scheduled batches, and IMPS, the 24/7 engine that defines modern consumer finance.
And as we went through this, we found those surprising nuances that define the whole ecosystem. We uncovered the dual role of NEFT, acting as that crucial bridge for financial inclusion.
Allowing cash deposits without an account.
Right. We recognized the technical complexity of the MMID and IMPS, and we discussed the transformation of the humble ATM into a multi-device mini-bank kiosk.
Every mechanism is now engineered for minimized friction and maximized speed. The competitive pressure to deliver 2047 access has forced banks to innovate, even waiving fees on large IMPS transfers to win over customers.
So we circle back to that central tension, the trade-off between speed and safety. The move to 247 digital finance has maximized convenience, but the sources repeatedly underline the substantial financial risks.
From viruses and technical limits to those devastating non-revocable data entry errors like entering an extra zero, systems like IMPS and RTGS are instant and they are final.
Which raises an essential question for you, the user. How does the instantaneity and constant availability of these 247 systems fundamentally change the way we view the risk associated with handling large sums of money?
We've gained incredible convenience, but in eliminating the time needed for human double checks, the friction of the old system, have we inadvertently increased the likelihood and severity of non-revocable, costly mistakes?
That pause, that critical moment of caution, is now entirely in your hands, the user, as you tap send on that next transfer. Something to mull over as you navigate the new reality of instant final digital finance.